All right, what is up, traders? What's up, tycoons? Super excited for today's video. Stocks headed to the moon if Yellen whips out a surprise this month, says Nomura strategist. Now, is that actually the case, or should we be more bearish right now? We're going to dive into what this surprise is and really explain what that means for investors and traders. If you take a look, we'll also talk about financial conditions. They've eased by the equivalent of 160 basis points of rate cuts. Huge drop here recently in financial conditions. All right, we're going to talk about earnings too. Okay, we'll go over the Q4 earnings estimates, all right, and talk about some earnings revisions that we've had. As always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. If you're new to the channel, I actually started a completely free newsletter for you guys called Investment Intelligence, giving out free valuable finance content, and I try to put out 1 to 2 free trade ideas a week. There's a lot of really interesting setups that I'm seeing right now, so I'm excited for the upcoming newsletters. Subscribe to that using the link in the description. Right, and you can actually gain access to the Investment Intelligence Discord for just $1 right now. Okay, so promo code JAN24 will get you into the Discord for only $1. Now, we talked about with the newsletter about 1 to 2 free trade ideas a week. The Discord is where you're going to get access to all of my different analysis, all the different trade ideas, as well as other valuable resources, custom scripts, indicators, and things like that. All right, now let's start off here with quarterly earnings. All right, Q4. It's basically at a 1.3% estimate. All right, so really nothing spectacular there, right? You can see that this is basically almost flat. Okay, now we just came from periods of negative, right? We had positive earnings here recently, and the estimate is supposed to be positive. Now we're bringing this up because earnings season has begun. The banks kicked off on Friday, and we're going to have some more banks reporting, some more financials reporting, and earnings season. You know, it's going to be a good indicator of whether or not earnings is actually going to matter for 2024 for prices. Okay. Now, there's lots of people who, will buy and sell a stock based off of valuations, based off earnings reports and things like that. But, the market itself, all right, sometimes doesn't care about earnings so much. All right. Shorter term. And so, this will be a good indicator for us for, what the market's take on earnings is, whether or not it's actually something that's going to impact the prices. Now, what's important to note specifically into earnings season is that EPS revisions have hit negative again going in. And per the back test, that is a bullish signal for the index, i.e. the old low bars to beat phenomenon tends to see larger index upside median returns and at a higher hit rate. So if that sounds like a whole bunch of jargon, basically what's happening is they're lowering the expectations so it's easier to beat them. Okay, and that happens all the time. It's very common, and some people say that it's done on purpose, right? They make it easier to beat expectations. Now, just because something beats expectations doesn't mean that prices are always going to go up. There's things like guidance, okay? So guidance for the next quarter, guidance for the rest of the year, for next year, etc. Oftentimes, those have a big impact on prices as well. Now, financials. All right, as we mentioned, the banks kicked it off on Friday, and a lot of people are paying lots of attention to the banks right now. And some people even say that financials, could outperform in 2024. Now, when you take a look here and you take a look at the S&P and financials, you can see that financials are trading cheaper than the S&P 500 right now, pretty much across every single metric. Okay, you take a look at price to sales ratio, price to book ratio, PE ratios, different things like that. And this is one reason why people are kind of attracted to the financials right now, is because of some valuations, right? And they think that, hey, valuations could be a tailwind for them, and price could catch up as those valuations potentially rise if they report good earnings. Now, what's really interesting is that a lot of people are also very panicked and worried about banks, specifically smaller banks, okay, and regional banks. Yes, everyone knows about the regional bank disaster, and a large portion of that was due to treasury allocation and bond allocation, and not having interest rate hedges, interest rate risk hedges. But when you take a look here, what we've got is the large banks right here, then we've got the small banks, and you can see that 44% of total loans and leases is in commercial real estate. Okay, and a lot of this commercial real estate is due for refinancing. Okay, and interest rates are very high compared to what they were when a lot of these loans were initially, given out. All right. And it's something that a lot of people have been saying. A lot of the bears have been going on and on about the commercial real estate crash, right? And, that's one thing that's got me pretty interested is, a lot of the people who were bears on commercial real estate and smaller banks, they're actually now flipping a little bit more bullish. It's still a big cause for concern, in my opinion. Now, do I think that it's going to cause a economic downfall and, the next big economic crash and a recession? Not necessarily. Okay. If you take a look, a lot of these companies these days, they're not requiring workers to come back to the office 5 days a week. Okay, maybe there's a 2-day work week. Some places, they've limited it down to 4-day, and the other days you work from home, or maybe 1 day a week you work from home. Lots of different situations. But the other factor with commercial real estate is that a lot of these buildings were built in the 50s, 60s, 70s, maybe even the 80s. Okay, so you've got to ask yourself the question right now. In a world and in a U.S. market, in a U.S. economy right now, where workers don't want to go to work anymore, they don't want to go to the office, they prefer the work from home environment, okay? And I'm speaking generally here, all right? This may not apply to you specifically. Are you going to go out and you're going to go buy a commercial real estate property that was built in the 50s, 60s, 70s, or the 80s? No, you're not, right? You need to have nice office, new equipment, preferably a new building or a newer building, all right, that can attract people and create a environment that people want to work in, right? And they say, hey, well, my office looks really cool. Whether or not that sounds silly, that is something that's actually kind of important. All right. If people are going and working in some old, beaten down, run down building, that's going to affect their mindset and going to affect, how they work potentially. Now, back to earnings. If we take a look at earnings growth, price returns, the trailing 12 months PE ratios, this goes back to 1989, right? You can see in red, those are periods of contraction. That's where we're seeing a negative percentage change in the price to earnings ratio, right? And we just came from 2 periods of contraction in 2021 and 2022. And now 2023 we saw was a year of expansion. So will that expansion be able to continue in 2024? And if so, how's that going to impact the stock market? Okay, that's, if you take a look, all right, you can see there are periods where we do get expansion in the PE and, price to earnings ratio. But if you take a look at the percentage change in the S&P 500 price, there are times where we see PE expansion and we see negative returns in the S&P 500. Okay, just like there's times where, we have, contraction and we see positive returns in the S&P 500. So, like I said, sometimes earnings is a really big factor in the stock market. And, sometimes it's not, right? And it's not always going to be crystal clear. But now that we've got, a new earnings season, 2024 has started now, it's going to be interesting to see how the market reacts to this upcoming earnings season. Now, back to the big surprise with Janet Yellen. Okay, what exactly are these people talking about? Well, what we've got, and this is coming from Charlie McElligott, I think is how you say, right? But basically what he's talking about is that stocks may get a surprise boost from Treasury Secretary Janet Yellen at the next quarterly refunding announcement, the QRA. Now, this is expected January 29th. All right, this is the government's borrowing plans. That is, the size of auctions and debt duration have become an increasingly monitored event. Now, I haven't read a truer statement than that last sentence in a long time, okay? This is something that people didn't even care about or pay attention to. But because of interest rates, because of treasury yields, because of the crash in the bond market that we've experienced, over the past few years, this is something that people are just so focused on now. Okay. And the last time we had a good surprise, the stock market actually rallied very, very nicely. So here we are with many clients I speak to believing that both stocks and bonds have overextended too much too fast into the start of 2024 with widespread expectations of a healthy pullback soon. Now, just to back up, coupon refers to how much interest a bond will pay out to an investor, and higher interest rates over the past couple of years has driven up coupons for bonds. Treasury bills, on the other hand, do not offer a coupon, as they are instead sold at a discount rate to their face value. And so he reminds traders of the binary risk into the end of this month and early next from that Treasury QRA, where many are expecting a resumption of coupon issuances increases. Now, under that outcome, expect U.S. Treasuries lower, the long end yields bleeding higher, and this will retighten financial conditions and collectively then act as a headwind for now high valuation equities. Okay. And so this is the big risk heading into that. And this is what bears are going to tell you. Okay. This is the narrative that they're going to push. This whole paragraph, this couple of sentences really that I just read to you right there. This is something that most definitely can become a headwind. And we talked and we'll revisit, the financial conditions easing so much. And a lot of people are saying that they need to go back up, right? And that, it's a little bit of a problem. But when it comes to the surprise, the alternative scenario, all right, would be that what if the consensus path for the QRA yet again sees political interventionism / activism from the Treasury's Yellen, and she not only again leans on more bills with less coupon increase than currently anticipated, but then also too clearly provides guidance to markets that this is the final coupon increase moving forward. This is how we get the right tail, says the strategist, who explains that such a shocker would help ease financial conditions and lead to a flattening of the yield curve with long-term rates falling faster than short-term ones and lower real and nominal yields, helping risk assets rally. So essentially, it's going to be kind of a really big binary event. Okay. Now, whether or not it has lasting impacts, we'll see, and what I mean by that is something that affects the market more than one day or 1 week, and whether it really shifts a big tone for, a few months or for a quarter, or not. That's what we'll have to see. But that's basically the bear case and the bull case right there. And it is going to be something that a lot of people are watching, right? And a lot of people are going to be, paying a lot of attention to this. And I do think that it will impact the market as a result of all the eyeballs and all the attention that the QRA is going to be receiving. Now, when you look at the risk on, risk off gauge, and the ranking is based on the average of 6 futures contracts relative to their own daily trading history. You've got the S&P 500, the NASDAQ, oil, gold, 10-year treasuries, and the US dollar. All right. We can see here, all right, that we're basically in a risk off environment at the moment. Okay, basically leaning more towards 44%. Above 50% is going to be risk on. Now, I've done some videos kind of how to measure whether or not a market is risk on or risk off. One really good way to do that is to look at credit spreads. You can check out my credit spreads playlist. It's not credit spreads as in options trading. Okay, these are credit spreads and these are basically the spreads in bonds and treasuries. Okay, in different forms of bonds. This is a really good way. And, we saw the market really shifting to a lot of risk off early in the year, in the first week of the, 2024 year. Now, since November, financial conditions have eased tremendously, right? If we just take a look right here, financial conditions have tanked, right? And it's very easy to see that. It's not a coincidence that also coincided with, a tremendous stock market rally. Okay, the market pretty much bottomed short term in October and really just started ripping face and rallying tremendously, through November and December. Now, why is this important? Well, when you take a look at the developments in financial markets and open market operations, the easing in financial conditions reversed some of the tightening that occurred over the summer and much of the fall. Now, participants generally viewed risk to inflation and employment as moving toward greater balance. So, the Fed was essentially telling people that, hey, you guys kind of reversed a lot of the work that we did, right? When we saw financial conditions tightening, that was doing a lot of the Fed's work for them. Okay. And so they were saying, hey, we haven't really had to raise rates as much because financial conditions have been tightening for us. And the markets have been doing a lot of it, for us. And it's basically reversed all of the work that the financial conditions did when the Fed was saying that they don't have to raise rates anymore. Now, when we talk about some of these bearish setups and bearish scenarios, right, there's a few charts, all right, and really we're seeing lots of bearish formations in not every single stock and every single sector, but this is a list right here of just some rising wedges, right? We have FCX, this is Freeport, we have Citibank, this is C, we have PPL, we have Verizon, we have Excel Energy, XEL, we have Darden Restaurants, DRI. This upcoming week is historically one of the worst weeks for the S&P 500 over the last 2 decades. So if that's going to be true, these are going to be some stocks that I'm watching for potential downside action or potential shorting opportunities if this is going to be one of the historically worst weeks for the S&P 500. That's pretty much it for today's video. Hopefully you guys enjoyed it. If you did, smash that like button, subscribe to the channel. Don't forget to sign up for the free newsletter, Investment Intelligence. You can get those free trade ideas, free valuable finance content directly to your inbox every single week, right? If you take a look at some of the previous newsletters, you can see how well those trade ideas worked out. There is a website associated with it, so you can go back and review everything. RTX was one of the most recent trades. That was December 28th. And you can see people in the Discord saying, hey, my January call options went up 88%. They ended up going up much higher than that, over 100%. And remember, if you want to join the Discord, it's only $1 right now. Okay, we're trying to kick off the new year strong. I'm letting people get in basically for free. It's just $1 to get in if you use promo code JAN24, and that's where you'll get access to all of the different trade ideas, all of the different analysis. Literally just yesterday, I just posted over 20 of them. So there's plenty of different things to look at, whether you're an options trader, whether you just long and short shares. There's going to be something for you in the Discord, and I think you guys will really enjoy it. And hopefully I see you there soon.